Well, it's my first video for a while, so there's been no content on the YouTube channel for a few days. I think the last video I did was like Wednesday, but I've just been doing a bit of overtime at work and it's just been absolutely chaotic and I've not had time to record any videos. So here we go, I'm doing a bit of an update of what I kind of missed out on last week, and then hopefully next week will be okay and we'll have videos back up on the YouTube channel. That does also mean on the Patreon, I'm catching up on the Patreon videos as well. We did the earnings review last night for the previous week. The week just gone, I'll do that earnings review in the next coming few days after I've gone through a few conference calls. It's just everything at once at the moment. What a bad idea it was to do overtime when it's like the peak of earnings season as well. So got a few conference calls to go through, and then I'll do an earnings review for the week that's just gone, and I'll also do my US portfolio on the Patreon as well in the next 24 hours. So there's a lot of content on there. If you do want to join and see the exclusive content, 2 exclusive videos a week on Patreon, join through the link in the description. It's only £5 a month and you get Discord with 500 members on to talk to, including me as well. So if you do want to join, that link is in the description. But first of all, the first bit of news I didn't really talk about since this happened is inflation data. I wasn't going to talk about it, but I thought, you know what, I'll just speak about it for like 2 or 3 minutes and just give my thoughts on it. Obviously, inflation has gone up for the first time for a very long time. It's gone up from 3% to 3.2%, which was lower than the 3.3% expected. This is still relatively pretty good. I mean, obviously we are still very close to the 2% target. We are 1% off that target. We are not that far away from the Fed's target, and the fact that people are losing their minds over this is absolutely crazy. I mean, we got to the point where you got to remember we've rapidly come down. We've come from 8.3 down to 3% very, very quickly. We were saying that will we hit 3% by the end of the year, and we've got to 3% by summer. We will get to 2% very soon. The problem is that when we can't go much further. You've got to realise that we were at 3%. The days of it rapidly coming down had to come to an end. We saw it rapidly come down from 4.9, then down to 4.1, then to 3%. We saw nearly 2% drop within 2 months. There's a point where you can't go physically that much lower that rapidly, and you've got to bear that in mind. Now, obviously, when you do look at the inflation data, though, it does look still, even though it went up this month, it still looks incredibly positive. And the reason why is that if you do look at the actual CPI report, it actually said that the index for shelter was by far the largest contributor to the monthly all items increase, accounting for 90% of the increase. So 90% of the increase came from shelter, which is absolutely crazy. You take that out of consideration, we would have easily been in the 2% range. And the shelter is a key thing. We've talked about this so many times on the YouTube channel, and I don't want to repeat myself because I've talked about it so much on the YouTube channel, but shelter is the lagging indicator. When you look at shelter is the slowest thing to increase to inflation. After everything's gone up and these longer term contracts start then coming out of the 12-month contracts, whatever, then they start going up. So this is a slower indicator, lagging indicator, and this is what's absolutely bonkers, that the Fed are looking at this inflation data going, well, it's still a little bit off our 2% target, and it's like, well, the only reason why it's off the 2% target is because the really slow lagging indicators are now catching up. Once this has gone out the way and everything starts to calm down here, we're easily going to be in the 2%, maybe even the 1%. Maybe we start pushing into deflation. That's the really scary thing, and that's what is frustrating to see. That I've always said the biggest risk to the economy out there is the Fed, and it still to this day is the Fed. They are, we shouldn't be seeing increases because of lagging indicators, but they still are. So I mean, that's the worrying thing, is that the CPI report was once again pretty good reading, but you can't really trust the Fed, and I don't trust the Fed that they'll look at that in the right context. And just to put it into context as well, when you look at the CPI report, shelter is 23 to 24% of the report. The weighting, which is absolutely crazy. And there was a little bit of jump in the oil price as well. As you can see here, I've got the I think it's the crude oil I've got here, and you can see that it went up quite a bit as well in the month. Obviously, the reason why is because of the cuts of the output that we've seen at the moment. Obviously, I won't get into this too much because once again, this is another topic that I could go into, and I could spend 10 minutes alone on this, but basically, they're looking at a lot of the oil prices, and oil prices going down, and they're not making as much money, so they want to make money again. I'm not going to go into my opinions on that, but it's stupid. And obviously, this is a big thing when I look at true inflation. True inflation is a lot better indicator than the actual CPI reports. The CPI reports that are tailored to lagging indicators, that are heavily weighted on lagging indicators, are pretty useless. And when you actually look at true inflation, we are at 2.1%, 2.18% at the moment, and that's a better indication of where we're actually at with inflation. And this is, more reflective of where we are, not to be using, lagging indicators that are more heavily weighted in the index. Unfortunately, we are in a good place with inflation. However, the Fed at the moment, unfortunately, is, using lagging indicators to make their decision. And, sooner or later, as they keep increasing the interest rates, at some point the economy is going to snap. We shouldn't have seen increases in interest rates probably 3-4 months ago, and yet we still see them increasing. And looking at this report now, if the context of what we've seen previously is anything to go by, they'll look at this report and go, oh no, we need to keep putting it up when it doesn't need to. So I mean, it's a good report. Unfortunately though, I wasn't going to cover it because I believe that it won't make any difference, because the Fed are just making the wrong decisions and will continue to increase interest rates, which is stupid, but that's where we're at. DraftKings. So obviously I made a video on DraftKings and ESPN, the deal. That was the last video that I did, which I think was on the Wednesday. And some of the reason why I've not had time to record a video is because obviously DraftKings is my biggest position, and I've been doing a lot of research into DraftKings and what threat this ESPN deal with Penn National could make for DraftKings, because I thought this could really affect my account and my biggest position, and do I need to change that position at all because of the threat. Now obviously on Friday DraftKings had a good day, up nearly 6%, and it started to recover some of the dip that it had off its ESPN dip. And I've got to say that I can see why people are buying this, because I think a few people are realising actually this ESPN deal isn't a big threat to DraftKings, and that's what seems to be happening in the last few days. People realise this isn't as big deal as what it kind of sounded like when it actually came out. And I think even Penn National, you look at Penn National, their shares are actually now down lower than before the deal came out, which says a lot. So DraftKings is now high, is starting to recover, and Penn National is now lower after this deal was announced. And digging into the deal, you've started to realise how actually this doesn't really benefit Penn National that much, and doesn't affect DraftKings. It doesn't affect DraftKings from a point of view that they can actually, and this was the big thing that I had to kind of find out, is they can still advertise on ESPN. So they are not really affected that much in any way. They can still advertise with ESPN, which then looks at Penn National like, well, you haven't really got that much exclusivity if, that they can still go advertise on ESPN. Obviously, they'll want the advertising money. The other thing as well is that when you look at DraftKings, they turned around and rejected ESPN originally. So DraftKings could have got this deal if they wanted to. They just went, it's way too much money. And then after the deal was, DraftKings rejected the ESPN deal, ESPN actually then went to Flutter and said, we would like to have the deal with you. Flutter then turned around and said, no, you're too expensive, we're not doing this deal. So the fact that both of the big market players that own like 80-90% of this market share both went, this deal doesn't work, probably speaks volumes about it's probably not going to work. Because if it was a good deal, one of them would have took it, and both of them said, no, we're not having this deal, it's too expensive. So that's obviously really good that DraftKings and Flutter, FanDuel, basically rejected the deal. Also, as well, I've not got the confirmation of this, but I've heard inside knowledge that DraftKings actually looked at the customer acquisitions they got from ESPN and advertising with them, and it's actually not that much. So that actually says a lot. And it's clear. I said this the other day. I think it's probably clear that FanDuel don't advertise with ESPN, and they still become a big player. Clearly, a lot of the DraftKings is a big brand now. They don't need ESPN advertisement to do that well to get customer acquisitions, which is obviously really good. And that's obviously another thing that was worth pointing in there. And the other thing that I think people realise is that everyone assumed, oh, this is going to be a mega deal, Penn National, ESPN bet. But then I think a few people actually realised, actually, Penn National aren't very good at this because they looked at what Penn National did last time. Penn National acquired Barstool Sports. Their thinking was, oh, if we have Barstool Sports, we'll be able to get a big customer base already, save our costs of acquiring customers because we'll just acquire Barstool Sports. And that absolutely backfired. They paid $500 million for it, and they've just got rid of it for $1. So the fact that they're trying to do the exact same tactic as before is, we'll get ESPN, we'll use ESPN customer base to get them on the platform, and we'll do very well. People actually went, well, you did that exact same tactic with Barstool Sports, and it failed. So just paying a bit more and getting ESPN, you think that's going to work for you? I think a few people realise that it's not a given. And what I think, if anything, is a good thing about DraftKings is that more than anything, you look at DraftKings now and you go, well, a lot of people have always questioned the moat on DraftKings. People have said, oh, it's an easy moat to get into this space. I think, if anything, the story for DraftKings has probably got a little bit stronger because they don't need ESPN. You look at something like a Barstool Sports, they're able to knock off the competition from Barstool Sports, and you think potentially that it shows you how hard it is to get into this area to get a big customer base. It shows you that, it's actually quite a bit of a moat, that you've got to have the right customer ways of acquiring the customers, you've got to have the right tech, the right platform, the right offers, and it does show you that there's actually a bit of moat in this space that a lot of people said there wasn't a moat, which is obviously, once again, probably more of a bullish point to DraftKings that has come out in the last few days. And if anything, I think it just shows that, more than anything, ESPN, it shows you how slow it's taken them nearly 5-6 years to finally launch a platform, and yet they've still got to go through the whole process of building up a platform, acquiring the users, doing the marketing spend. It's going to be really tricky. It's going to be at least a year before they even build a platform. So it shows you that, ESPN, it shows you, for their point of view, to be taken 6 years to get to this point is so slow from ESPN and their management team. So yeah, and the last point I want to make is on a couple of stocks. The last a week and a half, it's funny how quickly it's changed. Only 2 weeks ago, I remember on the Patreon posting that I'm actually struggling to find things to buy, and I actually bought some shares in Aviva and Barclays because I was like, I'm just going to buy these stocks because they're going to be, and also another point that is probably bearish for stocks, just on the inflation point, is that obviously if interest rates keep going up, a few people are going to be looking, why do I want to go buy individual stocks when I can get this interest rate as well? Which obviously why stocks are probably being a little bit negative received at the moment. And the other thing is, for the stocks to rally, I think, to new highs, you've got to have interest rates that are staying the same or going down and pausing. Obviously, we're not getting that at the moment, and we're probably not going to get it at the moment, and that's probably why we're seeing the stock market have a little bit of a flat lining. And obviously, it's probably very, we've been on a very good run. It'd be a very good time for the stock market to have a good flat lining phase at the moment, which I think is worth saying. But I think a few people have been worried about stocks, and I was just about to say, for me, I thought I'm just going to buy Barclays and Aviva. I've got nowhere else to put money, and then within 2 weeks, boom, you're presented with all these opportunities. And a lot of it's come out of earnings season, and the crazy thing is a lot of this come out of earnings season with stocks kind of dipping on good earnings, which has been the really surprising thing. Like PayPal, PayPal is one that dropped 6% off earnings, and then it actually since then has dropped down 18%, and I'm at the point of view now where I'm looking at PayPal, I'm like, where do I get the money from to buy it? I've got to get the money from somewhere, and I'm like, do I sell this stock to get the money from it? But and the same with Hims. Hims brought out fantastic earnings. The stock was up 20% since it brought its earnings out, and then from that point of view, it's just gone lower and lower and lower. The stocks have nearly had a 30% swing since it brought out its earnings out, which is absolutely crazy. And it's funny where the stock market is at the moment, and I don't know what is causing the stock market to do this. I don't know if it is because people are looking and thinking, well, why do I want to buy that when I get a guaranteed interest rate? It's probably going to carry on going up. Is it the point of view that the Fed are going to carry on, hiking up interest rates? Is that potentially going to, snap the economy? Are we just due a break? Have we had just so much of a rally that we're due a bit of a calming phase? But you look at some of the small caps, and they're the ones that seem to be getting hit the most, not the stocks that have run up the most, which is the big tech stocks in the S&P 500. It's a really weird time frame that we're kind of in at the moment. So, it's strange to kind of know where we're at. But what I'll say is that it's good to have a buying opportunity, because only 2-3 weeks ago, I remember thinking, where do I put my money? Do I just put it in these kind of safe dividend stocks that are going to pay me the dividend? And now I'm looking at them going, well, now I've got the opportunities. Do I have to sell them out to go buy some of these really good opportunities? I am massively staring at PayPal thinking, where do I get the money from to buy this one at $61? So yeah, it's an interesting time frame once again, and there's a lot more going on at the moment, and a weird market sentiment that we've kind of entered in at the moment. So yeah, just an update what's kind of gone on in the last few days since I've recorded the video. So hope you enjoyed it anyway, guys, and I'll talk about the UK stocks I've been buying recently as well, probably on the next video once I've got time to put that together. But catch you in a bit, and apologies once again for not having a video for a while. See you later.